Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, June 19th, 2024. Hope you're having a fantastical day out there. It is a national holiday here in the United States. It is Juneteenth, so markets are closed domestically, but there are still some things going on in the world. I was sitting here like a moron waiting for 2 o'clock, waiting for the market to close, and then I realized the market's closed today. I could just start. So anyways, like I said, hope you're having a good day out there. It is a beautiful day here again in Colorado. The temperatures are in the 60s again. It's actually chilly in my house. I woke up, I'd left the windows open. I was like, oh my God, it's freezing. All right. Well, if it is your first time watching Liberty Call, if you are watching on this holiday, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All right. Well, let's go ahead and get to the global markets and see how they did. Obviously, the three majors here domestically were closed. Let's see. Let's go to Canada. Canada was down 0.44%. Let's see here. Brazil up 0.58%. Mexico up 0.09%. In Western Europe, Germany was down 0.36%. The UK up 0.17, France down 0.77, the Netherlands down 0.37, Spain down 0.1%, Italy down 0.29, Switzerland up 0.1%, and Portugal down 0.44. Russian exchanges closed also, and the overnight, the Nikkei in Japan was up 0.28%, Australia down 0.11%, New Zealand down 0.46%. In China, the Shanghai was down 0.4%, the Shenzhen Component down 1.07%, China A50 down 0.09%, DJ Shanghai down 0.54%, Hang Seng was up 2.87%, and the Taiwan weighted when it closed last on the 18th was up 1.16%. All right, so those are the global markets for today. Let's go ahead and go to a global market recap. Stocks bask in Nvidia glow as the dollar is steady. All right. Global stocks reached new record highs on Wednesday, propelled by a surge in tech shares, notably AI chip maker Nvidia, which became the world's most valuable company. The MSCI All World Index rose by 0.15%, hitting an all-time high of 805.43. Nvidia surge boosted chip makers in Asia and lifted U.S. stock index futures, with the NASDAQ 100 futures up 0.23% and the SP 500 futures up 0.1%. In Europe, the Stoxx 600 fell 0.1%. The British pound strengthened after data showed inflation returning to the Bank of England's 2% target in May for the first time since 2021. Despite this, the anticipated rate cut from the Bank of England on Thursday might not happen. Sterling traded at $1.2728, up 0.15%, while the euro rose 0.1% up to $1.0747. Let's see. Soft U.S. retail sales data suggested a potential rate cut later this year, increasing the likelihood of easing up to 67% for September. U.S. markets were closed today, keeping overall market volatility low. U.S. retail sales showed minimal growth in May, with prior month's figures revised lower, indicating weak economic activity in Q2. Despite mild inflation readings, the Fed's stance remained hawkish, reducing their median projection for rate cuts this year from 3 to 1. In commodities, oil prices rose, with Brent crude futures up 0.6% to $85.80 a barrel, and U.S. crude futures up 0.48% to $81.96 a barrel. The dollar index held steady at 105.19, and the Japanese yen remained mostly unchanged at 157.92. The market remains optimistic about potential rate cuts, supported by cooling inflation and a strong labor market, though the Fed seeks more data before making any moves. All right. Next up, I got an article from Zero Hedge titled U.S. markets may be closed, but tech stocks continue to melt up. So that's really been the big story this year, is that, those few tech names have just really been, why do I have this screen like this? Those tech names have been just, through the roof, and everyone else is just kind of lagging behind, like, what the hell's going on? So, all right. Global stocks hit record highs Wednesday, driven by tech shares. We already talked about that, especially Nvidia, which became the world's most valuable company. Let me skip down. Let's see. U.S. NASDAQ 100 futures extended their gains for the 8th consecutive day, while S&P 500 futures were steady. The recent tech rally was fueled by a slowdown in consumer inflation in May, boosting expectations of a potential rate cut in November. Maraja Vietmin of State Street Global Markets emphasized the strong support for the information technology sector, highlighting its better earnings growth and stronger margin defense. Yeah, for now. Despite the tech rally, the broader S&P 500 showed mixed performance, with some stocks struggling. French and European stocks also faced challenges, with the stock 600 slipping a tenth. It's a lot of the same. This article is a lot of the same data. All right. Oil prices with Brent crude trading at around $85.50 reversed earlier losses. Spot gold remained steady around $23.30 an ounce, and U.S. markets were closed. So, all right, a lot of the same data in that article. I breezed through, or as I perused the articles during the day, I just set them aside. So sometimes we get a lot of duplicate information. All right. Last up, just kind of a commentary on the world. This comes from the Mises Wire: how Washington and the Fed caused the commercial real estate crisis. All right. Commercial real estate is currently experiencing significant distress, primarily due to the inability to service debt. The financial distress, characterized by the failure to meet loan payments, is exacerbated by the broader economic management of policies of the government and the Federal Reserve. The Federal Reserve's strategy of increasing the money supply, particularly over the past 15 years, has disrupted the natural demand for money. This artificial inflation of the money supply initially benefits large financial institutions, which then direct this excess liquidity into capital markets, including commercial real estate. The 2010 to 2020 period saw a doubling of the money supply and a corresponding tripling of the stock market, despite minimal real wage growth, illustrating the disconnection between financial markets and the broader economy. In the commercial real estate sector, particularly apartments, the influx of money led to a boom in high leverage floating rate bridge loans during 2020 to 2022. These loans drove U.S. property prices and reduced cap rates, creating an unsustainable bubble. The assumption that interest rates would remain low and operating incomes would significantly increase proved unrealistic, leading to widespread financial distress when the Federal Reserve raised its rates in 2022 to combat the inflation from printing all that money. The repercussions of this distress are extensive. Many apartment properties financed with bridge loans face foreclosure or debt restructuring, with substantial losses for passive investors. Commercial mortgage-backed securities and real estate investment trusts are also experiencing increased financial distress, as evidenced by rising default rates and liquidity issues in entities like Blackstone's REIT and Starwood's REIT. The sectors such as office, retail, and hospitality are similarly distressed. Office properties have been particularly hit hard by the shift to remote work during the COVID-19 pandemic, leading to significant devaluations and sales at steep discounts. Retail and hospitality sectors, though less fundamentally impacted, still suffer from the residual effects of pandemic-induced disruptions. The distress in commercial real estate is also posing a risk to the banking sector. Regional banks holding over $2 trillion in commercial real estate debt face potential crises as loan losses erode their capital reserves. This could lead to bank failures or require regulatory intervention reminiscent of past financial crises. The prevailing solution proposed by some within the industry is to lower interest rates to alleviate distress. Yeah, because creating more inflation is always good. However, this approach merely perpetuates the cycle of bubbles and bursts created by loose monetary policy. The argument is made for allowing market corrections to proceed without government intervention, thereby penalizing imprudent actions and avoiding the long-term consequences of repeated bailouts and artificial market support. I agree. Our government should stay hands off, regardless if it's the real estate sector or the stock market or whatever it could be, because when the government comes in, prints a bunch of money, creates a bunch of inflation, and then bails out bad business behavior, all you're doing is rewarding that bad business behavior. And those, the people who run those companies, get huge golden parachutes and large stock options and all that sorts of stuff. So, is it fair to a little guy like you and me who are covering the bill for these idiots? No, it's not. So. Anyways, all right. Well, that's everything I had for today. It was a light day on news. And if anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. If you need to get your financial crap together, give me a call or shoot me an email. I'll be happy to help you. All right. Well, like I said, that's everything I had. Me and my boy Jake are going to go out and throw the ball a little bit. I have meetings later tonight, so it's going to be a late evening. And I hope everyone has a good evening, and I'll talk to you next time. Adios.